Mr. Richard Johnson. He's the CEO and founder of Texture Capital. We are grateful that he accepted our invitation to join us and make a presentation on this important topic. Security tokens landscape is an important topic, and he's going to be discussing that. Richard has 20 years experience in electronic trading. He has worked at Societe Generale and several other firms over the past 20 years. And for 5 years, he worked at Greenwich Associates as a research analyst, and his expertise in the area of crypto assets, blockchain, and equities market structures is what he was doing at Greenwich. Richard will discuss what security tokens are, why they're needed, how tokenization takes place through various platforms. He will talk about compliance issues and other related topics. Dr. Sanjay Bhatna, my colleague, is here also, and after Richard's presentation, he will be asking or handling the Q&A session. So please, as you type in your questions, please identify yourself and what university or organization you're from, and the questions will be submitted to Richard at the end of his presentation. With that, I want to turn the floor to Richard.
Thank you very much, Ali. Thank you for inviting me to participate in this HBCU blockchain series. I was expecting, of course, to be at the live event this week, but obviously that's not possible. So I commend you on managing to move this into an online version. So let me just share my screen here. Great. So yeah, I'm delighted to come and talk to you about the US security token ecosystem. You know, it's I think it's kind of one of the most important areas of blockchain development within finance right now. Let me tell you a little bit about me. I founded my company Texture Capital last year in 2019, and we are building a regulated broker-dealer for the issuance and trading of security tokens. You know, I was previously at Greenwich Associates, as Ali mentioned, as a market structure analyst covering the space. But I spent most of my career in finance, starting out at a company called Barra doing quantitative finance. And then I moved to another firm called ITG, which has since been taken over by Virtue, which specialized in trading. They operated a well-known ATS called POSIT. After that, I moved to a startup broker-dealer that was called Middleton's Trading, building algos and smart routers for the US equities market. It was a very, very high growth and fun industry at the time. And we ended up selling that company to LiquidNet. LiquidNet is one of the largest dark pools in the US and very, has a very unique matching model. But, so helps, institutional buy-side traders match, buy and sell orders. And then after that, I went to Societe Generale, a big French bank, and I ran their electronic trading desk for a while there in the US. But around 2014, I got very, I think that the space I had been in, the electronic trading space, had become a little bit more commoditized. We were post-financial crisis now, so the margins were down, business was harder overall. And I was looking for, what's going to be the next big thing, I thought. And I was very fortunate, I think, to stumble across Bitcoin at the time. And I initially came at it with a trader's mindset, thinking, oh, look, we've got another asset we can trade here. Maybe we can build algos for it. Maybe we can build some smart routers and things like that. But I quickly realized that there's a lot more to Bitcoin than just something to trade. There was a very revolutionary technology underneath that. For the last 5 years, I've been very focused on the space, Bitcoin and blockchain space, most of it at Greenwich Associates as a market structure analyst, which is where I kind of, saw what I think I saw the writing on the wall that we were moving towards an environment where security tokens were going to be the next wave in blockchain evolution. So before I get to that, I want to talk a little bit about how we got here. So everyone, I'm assuming dialing in is familiar with Satoshi Nakamoto, the inventor, the pseudonymous inventor of Bitcoin. And maybe someone, maybe many people we don't really know. But about 10 years ago, in October 31st, 2008, he or she or they dropped a white paper on the internet called Bitcoin, a peer-to-peer electronic cash system. It's it's a great read, and it's a very much a revolutionary new approach. What Satoshi says in the paper is that what is needed is an electronic payment system based on cryptographic proof instead of trust. We propose a solution to the double spending problem. So the double spending problem in a digital world is, let's say I send something to Ali, a digital file representing, pretend it can represent money, but the reality is once I send it, I still have a copy of that digital file in my sent items folder. And Ali has another copy of that in his inbox as well. So that's the double spend. You have two copies of the digital asset at this point. What the Bitcoin white paper establishes is a way for me to send that to Ali and for it to leave my possession and transfer to his possession. That was a revolution. And I think it's very interesting to contrast that with the comments of Milton Friedman, who said in 1999, almost 10 years before Satoshi came along, the one thing, talking about the internet here, the one thing that's missing that will soon be developed is a reliable e-cash, a method whereby on the internet you can transfer funds from A to B without A knowing B or B knowing A. And that is exactly what Satoshi developed. So underpinning Bitcoin, of course, is the blockchain technology, which is revolutionary. It's a distributed ledger, cryptography and proof of work, consensus, enable a Bitcoin transaction to be settled in 10 minutes between two parties without requiring a trusted third-party intermediary. Whenever you have transferred value between two people online or in other formats, you need a trusted intermediary like a bank. Bitcoin is a way of moving money around the world from anyone to anyone else in any country, really, without the need for these third-party intermediaries. And it was and is still a very, very unique thing. So what happened was, Bitcoin grew from 2008, 2009 through about 2014. And then suddenly it started taking off and people started looking at it. When I say people, I'm talking about a lot of finance executives started looking at this and thinking, well, wait a minute, if we can settle a transaction in 10 minutes without the need for third-party intermediaries, maybe there are other applications of that technology that we can apply to institutional finance. In finance, I don't know how many of your students are finance as well as technology over there, but the settlement process has evolved over decades or even hundreds of years, in fact. And depending on the asset class you're dealing with can be very complicated. In 2014, the settlement process took 3 days for US equities, but the average for something like syndicated loans is more like 19 days. So then you have this new technology come out called Bitcoin, which can settle things in 10 minutes. That's a big deal. If you can reduce the settlement time and remove intermediaries, you can theoretically reduce costs significantly in terms of the cost of paying these intermediaries to do the work. But also, if you're reducing the time through the settlement cycle, you are reducing the amount of capital that's tied up. So you're reducing the cost of capital, which is a benefit to the financial industry overall. And this chart here we've got is it's from the DTCC website, and it is a high-level summary of the settlement system for securities through their network. For those of you who don't know, the DTCC stands for the Depository Trust Clearing Corporation, and they essentially clear all public US equities and corporate bonds and many other asset classes through their system. And it's a very complicated process. You can go to their website, you can take a look at this graphic they have here. Each one of these boxes you can click on, and there's a very complex description of how they all work. And that is what is essentially driving and helping the helping the trillions of dollars of financial asset transactions settle it on a daily basis. So we had a lot of financial firms come into the space. The narrative suddenly switched from, oh no, certainly among finance at the time, was it's blockchain, not Bitcoin. Everyone was much more excited about the blockchain technology and very wary of Bitcoin because of things like Silk Road and the use in other types of illicit activities. We had a lot of startups enter the space. I've listed some of them here: Hyperledger, R3, Digital Asset Holdings. These are some of the most well-known ones, and they were all backed by financial institutions such as HSBC, JP Morgan, and many, many others. So from 2015, we had banks and these blockchain companies, what I'm kind of calling enterprise blockchain companies, focusing on building solutions for using blockchain in financial markets. Could be for syndicated loans, for FX transactions, for equities, any kind of financial asset you can think about. Pretty much there was a company out there trying to use blockchain to reimagine the market structure and improve the workflows. These were some of the, and I'm citing some, I'm going to be citing some research in this presentation from Greenwich Associates, which is my former employer, but they did some really, really great research, and I wanted to share that with you today. So here they were talking to finance executives about what are the most important use cases for blockchain. Payments was a very popular one, and I know that the HBCU is sponsored by Ripple, or has support from Ripple. I don't know how to phrase that correctly. But Ripple, of course, is one of the larger blockchain companies using blockchain for payments. Very well known, very successful. In fact, when you think about it, payments is by far the biggest use case out there, because whenever there's a transaction, whether I'm selling shares or buying bonds or doing any other type of derivative or other type of asset trade, there's always going to be a cash leg to it. And in addition, payments are used to just oil the economy, to pay for food, to pay for housing, and so forth. So it's a very, I think that the notional value of, I hope I get this right, of global payments on an annual basis is 5 times global GDP, to give you an idea of how big it is. Second use case people looked at was trade finance. This is a complicated, trade finance refers to when a company in, let's say, in Asia is building widgets for a company in the US to buy, and they want to finance that throughout the cycle. So, there's a process where the widgets are made and they're delivered to the ship, they're put on the ship and they're sent to the US company that wants to use these widgets. And all that, along the way, there's lots of different complex processes that are not very transparent. So blockchain was seen as a good solution to bring some transparency and some automation to the space. Syndicated loans I mentioned, and these are many of the other ones down there. Worth mentioning gold as well, although it didn't rank very highly. There have been quite a few well-known blockchain projects focusing on gold, such as Paxos has something, and the Royal Mint, in conjunction with Scotiabank, have created some products around that as well. So that I talked about a lot of the hype we had in 2015 with all these new companies coming into the blockchain space. Fast forward to 2018, which is the chart on the left here we're looking at. I'm showing you the Gartner hype cycle here. Very, very important business tool invented by Gartner. If you're not familiar with it, give it a quick Google. It's on Wikipedia. But it talks about how different technologies evolve, and they say there's an innovation trigger, which is where there's a new invention, whether it's blockchain or AI, or some other type of in other technology like CRISPR for genetic sequencing, for example. Lots of companies come into the space. That's called the innovation trigger. Lots of hype builds up, and then eventually you get to what's called the peak of inflated expectations, where there's so much hype around it, but nothing's being delivered, or the solutions that are being delivered are very early stage solutions, and they're like like any company building a beta product or an initial release product. It's not as good as it's going to be. So we move into what they call the trough of disillusionment. And so in 2018, if you look here, we have blockchain just moving into the trough of disillusionment, as they say. And then this chart on the right is the Gartner hype cycle for 2019. What they actually did is they kind of created one specifically for blockchain, all the different types of blockchain products. But some of the key ones we see down here, distributed ledgers and blockchain, is down here in what's called the trough of disillusionment. And I think it's true to say that as of today, many of these enterprise blockchain initiatives have not lived up to their hype. However, this is a natural process of business development and business evolution. We've seen it in other industries. This is what Gartner based it on. After the trough of disillusionment, and perhaps there are some companies that fail, people try to experiment with certain use cases, and perhaps they don't work. But at each step along the way, the company learns something, and the next iteration becomes better and better. So the good news is that after the trough of disillusionment, we have what's called the slope of enlightenment and the plateau of productivity, very dramatic names. But basically, that's when the technology really starts delivering business value. So we're kind of, for enterprise blockchain, we're kind of a little bit in this trough of disillusionment, shall we say. I just want to kind of highlight something else in this chart. Tokenization, which is kind of where I'm focused right now, is kind of still in the innovation trigger stage. And that's what we're going to be talking about in a couple of slides from here. Okay. So meanwhile, that was going on in the enterprise blockchain space from 2015 to 2018. There was some other stuff going on in the cryptocurrency space during that time. And this is a very abridged sample of some of the crypto projects that launched and their associated icons. In total, we had over 1,000 ICOs in this time. So, first of all, there's Bitcoin. It was a very revolutionary technology. It was also open source technology. So what happened was we had a lot of copycats come out. Some were outright copycats. Some were, delivered real, innovation and improved and differentiation, such as Ethereum. I'm thinking of here. They focused on building a smart contract layer, which allows you to essentially, enable computer programs on the blockchain, automate some processes more smoothly there. But nevertheless, there was a rapid explosion of new projects trying to cash in on the success that Bitcoin had. So this was the crypto boom. By 2018, Bitcoin had peaked at $20,000, and the total market cap of all crypto was at 750 billion. I think it's about 200 today. So it's come down significantly since then. The chart on the bottom is showing you cumulative ICO funding. ICOs, by the way, are initial coin offerings, which was how these new crypto projects would launch. So essentially, you could have, I mentioned Ethereum, but you could have some other projects out there, such as, there's one called Filecoin, for example, which is saying, well, let's build a distributed database or a distributed file sharing system. So think of it like Airbnb on a blockchain, but for file storage. So if we have spare storage space on our network, we can contribute that to the system and receive payments in return for contributing this storage capacity. So companies like this and many others did what's called initial coin offerings, where they raised money by issuing a coin and then went ahead and started developing their product. So that's how Ethereum worked. Well, Ethereum was a kind of a crowd sale. It's a similar thing. All these firms did an ICO where they're raising money for projects that for something that doesn't exist, but something they're going to build over time. Now, for a while they went under the radar, these projects, but in 2018, at the height of the boom, when, as I say, you've got, as you see here, you've got $12 billion pouring into these projects. The regulators started taking a look at this and thinking, hang on, these companies are selling interests that represent, in my opinion at the time, and in many others, and in the regulator's opinion, these interests represented investments and securities investments. So we suddenly had, Jay Clayton, who's the chairman of the SEC, come out and say the SEC is devoting a significant portion of its revenues, of resources, to the ICO market. He also said, I believe every ICO I have seen is a security, back in February 2018. And they started bringing enforcement actions against all these ICOs for alleged violations of securities laws. So at that point, with this toughened stance, the ICO market in the US effectively died. You could still do an ICO, and you can, but there's a lot more restrictions on it. You would need to focus only on accredited investors, i.e. rich people who can supposedly, afford to make mistakes and afford to make bad investments. But generally, this market has kind of died in the US, although it does still continue in other jurisdictions. So what we see here is that, the regulators coming in, and surprise, and I took that at the time to be a clear indication that ICOs are going away. If we want to move forward with developing tokens based on blockchain that represents investments and securities interests, we would be moving towards an environment where the tokens are securities. So when you think about, well, what does that mean then? These aren't utility tokens like we could call Ethereum that, or some of these other tokens for prediction markets or file sharing or whatever. These aren't utility tokens now, we're calling them securities. So if they're securities, they're going to be subject to the Securities Act of 1933. Now, I imagine many of you joined this webinar because you're interested in blockchain technology and how to use it. Well, maybe a surprise to you, but when you're talking about using it in financial markets, you're going to run into securities regulations a lot. So I'm going to touch on that a little bit right now. It's going to be important as you're, kind of trying to develop blockchain solutions within financial services. You've got to be aware of the regulations and make sure you do things in a compliant manner, unlike many of the ICOs. So on the right there, I've just got a little mention of the Howey test. This is essentially, I'm not going to talk about this too much. I know that the SEC Commissioner Peirce is going to be doing a webinar in a couple of days. If you guys want to ask her questions, she's written quite a lot about this and spoken about this. But essentially, the Howey test refers to a 1946 Supreme Court case, SEC versus Howey, relating to the sale of land to grow citrus farms. Without getting into details of that, essentially, the Howey test was devised that determined a transaction was an investment contract if it's an investment of money, there's an expectation of profits, and the investment of money is in the form of common enterprise. Now, I'm mentioning this because this sounds a lot like what was happening with the ICOs. Let's think about it. They're an investment of money. People are investing money because they expected profits, and the investment of money was for a common enterprise, i.e. building this new utility token network. So that was, this was a test that, in 2018, everyone was talking about the Howey test. It was a 1946 Supreme Court case. But it's quite amazing how resilient some securities regulations can be, and it still applies today. Security tokens, there are some firms that are, or some product offerings that are on the line or in some kind of gray area between being a utility token and a security token. And again, this is something that Commissioner Peirce has looked into a lot. But for the remainder of this presentation, I'm going to focus on security tokens. They're definitely securities. So this is how I define security tokens. They're digital assets that represent an ownership, position, a creditor relationship, or rights to such. They differ from traditional securities in that they're represented digitally on a blockchain as opposed to in a physical certificate form or dematerialized form. Also known as digital securities or digital asset securities. So there's a few different words. One of the things about the blockchain space is that the nomenclature keeps changing. We've had cryptocurrency, crypto assets, digital assets, DLT, and so forth. Anyway, that's how we're defining it for these purposes. So, startups wishing to raise money from US investors can no longer do a traditional ICO, and they must issue compliant tokens or security tokens. So what does that mean? Well, we've got to refer back to the Securities Act of 1933, and there's a few options for being in compliance. The first one is you register under the Securities Act of 1933. Now that basically means you file what's called an S1 form and you do an IPO, so it's initial public offering. That's obviously what most people think about when they think about the securities market, the stock market. There are about 3,500 public stocks. The cost of going public is very expensive, or can be expensive in terms of Sarbanes-Oxley type regulations and ongoing compliance regulations. But also the market structure for public markets is much more mature. I showed you that chart of the DTCC settlement process before. There's a lot more infrastructure built up around it, and in my opinion, it's very difficult to innovate, and with so much legacy technology that you have to build interoperability with and backward compatibility with, it's very difficult to issue security tokens that are public equities. So Overstock.com has managed to do that, and there's a company called the Boston Security Token Exchange, which is trying to launch a security token exchange for public equities. But for the most part, I think players in the space are focusing on exemptions to the Securities Act. So there are exemptions to the Act of 33. Here are some of them here. So there's section 4A2, which is called a private placement exemption. This is how most venture capital firms, or many startups raise venture capital. There's something called Reg A+. This is an interesting one. It was introduced as part of it's called Reg A+ because it's updating the old Reg A, but you'll sometimes hear it called Reg A as well. It was introduced, and the new one was introduced as part of the 2010 Jobs Act, and allows companies to raise up to 50 million in a 12-month period. That's for tier 2. And you can raise this from the general public and not just accredited investors. So that's a key advantage of it. So it's kind of sometimes called a mini IPO. And in fact, that $50 million number is going to be increased, or there's an SEC proposal to increase that to 75 million in a 12-month period. So this is a good potential avenue for security tokens. Reg D is another one. This is the biggest exemption that's used. You'll maybe be surprised to hear that there's $1.8 trillion of Reg D issuances per year, every year. So there's a massive market here. You can only sell to accredited investors. That is, like I said, they're considered accredited by income, and I think it is you need to earn $200,000 per year for the last 3 years, or have a net worth of $1 million. Although those definitions are being looked at as well. But you can raise an unlimited amount of money under Reg D. So that is in fact the exemption that Texture intends to focus on when we gain regulatory approval. And then finally, I want to talk about Reg CF. CF stands for crowdfunding, also introduced on the Jobs Act. And the idea here is to help small businesses crowdfund smaller sums from everyday investors. So again, you can get it from retail investors. There are some well-known firms out there like Seed Invest or Start Engine. It's kind of like Kickstarter, but instead of just giving them money for the T-shirt or whatever, you get some securities or some revenue share in return. The threshold that you could raise there was 1,070,000. That looks like it's going to be increased to 5 million. So let's talk about some of the advantages of digital securities as I see them. Improved secondary market liquidity resulting from increased efficiency and reduced frictions. So when you're talking about private securities, there are some complex regulations around resale, And in a traditional, without blockchain, you would need a lot of kind of lawyers looking at this. It can be very difficult to sell something or to do a secondary market transaction. But with the addition of smart contracts, a lot of this can be automated, which reduces frictions. You have a full record of ownership and transaction history on the blockchain. This, of course, will represent the cap table, streamlined cap table for issuers, which can be a helpful tool, shows them who is owning what. There's a good example you might want to Google after this if you haven't heard of it, of Dole Foods. Dole Foods is obviously a very large company. There's a class action lawsuit, and the judge in that suit decided that all shareholders as of a certain date should receive a payout in relation to the lawsuit. So what happened was shareholders who owned, and I probably got the numbers a bit wrong here, but shareholders who owned about $42 million worth of 42 million shares of Dole Foods submitted those shares for a claim. However, Dole Foods only had about 38 million shares outstanding at the time. So there's a massive discrepancy on who actually owned those shares at that time and who was entitled to the payout from the class action lawsuit that took months to unwind and figure out. So blockchain, this is one of the main advantages you'll hear about blockchain. You've got a complete record of ownership, and it's time stamped, and you know who owns what and when. It's a big advantage. Programmatically enforced compliance through smart contracts, increased transparency, auditability, and accountability for investors, issuers, and regulators. Reduce frictions from security servicing. So something we can look to in the future is possibly being able to automatically pay dividends through digital securities on a blockchain. Future innovation is fully supported. I think there's a lot more we can do with things like consensus-based settlement, some of the very interesting features within blockchain. And also, there's, to the extent you study blockchain, you know that different entities can operate nodes on a blockchain. Well, one of those entities could be a regulator who wants to see what transactions are going on in a market at any point in time. So that's a key potential advantage. We very much look into the future in many of these items here. So I'm going to run through some of these. Again, I'm sourcing some data from my former employer, Greenwich Associates. What are the main advantages of security tokens, according to a survey of financial technology executives? Well, the immutable ledger of ownership and transactions history came top, followed by smart contracts and liquid secondary trading. What are the best applications for security tokens? So the chart here ranks top 1, 2, and 3, and the ones we see here is private placement. So that they're thinking about private securities, which, as I mentioned, is a less complex market structure for now, and startup capital formations, and maybe thinking a bit more about ICOs and how they were kind of startup capital formation for some of these technology initiatives. Speaking of private securities, I mentioned the data point here. This is the capital raised in the US market. So as you see by the kind of orange line, that is the amount raised in Reg D securities, 1.8 trillion. And the gray bar is the proceeds from global IPOs. So private markets in terms of new issuances are many times bigger than the public markets, which probably surprises a lot of people. Another data point here was like, what are the biggest challenges to security tokens in this in this day? And the top answer by far was a lack of regulatory clarity. So let's talk a bit about that. The regulatory environment in the US is evolving. I mean, this is a new technology, and the regulators need to be very cautious about how they adopt it. I think certainly the ICO boom, where there was a lot of fraud going on, has left a very bad taste in people's mouths. And understandably, the SEC and other regulators are moving with caution here. So some of the key things I want to highlight, speaking about stocks anyway, equities, is that under current US regulatory guidance, the blockchain cannot represent the ultimate record of ownership in a security. So in that way, it's not technically a digital asset at this point. They say there needs to be a transfer agent who is actually recording who owns what. And I think the concern here is that, well, if, especially as some, we're sometimes maybe using a private blockchain, or there are on the public blockchains, there are your risk of 51% attacks, for example, or unknown miners who are supposedly verifying these transactions. There's concern that if the blockchain is the ultimate record of ownership, there could be some manipulation and investors could be ripped off. So that's something that I think the industry as a whole will need to work through with the regulators. And the other thing we can't support right now is consensus-driven settlement. So whereas Bitcoin uses a proof of work settlement, other protocols use a proof of stake. And I think there's some others that use a Byzantine fault tolerance consensus protocol, which is perhaps more suitable for financial markets. But right now, we can't really use any of them because it kind of conflicts with 15C33, which is the customer protection rule, which essentially states that the security needs to be in the possession of control of a registered clearing entity or custodian at any point in time. And when the asset is kind of on a shared blockchain, shared among multiple parties, it's very difficult to ascertain who has possession and control at any point in time. So right now, these things we can't do. We hope that over time we'll be able to implement some of this blockchain technology into the space. So question here on whether you should use public or permission blockchains. In general, most people in finance and financial technology say permissions, not too surprising there. But I think we'll get to a space where public and permissions, or public can be as secure as the permission blockchains out there. And in terms of what's the most appropriate blockchain technology for security tokens, so the top one here was basically it doesn't matter. Number 2 is Ethereum. Ethereum, of course, is the blockchain used for the majority of ICOs. They are an ERC20 protocol. Some other well-known ones, Corda and Hyperledger, were mentioned. And I can tell you this as a founder building a company in the blockchain space, there's a lot of great technology out there that we can work with, and whether it's Ethereum or Corda or some of these others out there, we really are kind of spoiled for choice as we build businesses around this technology. And one of the last slides I have, some of the leading security token companies out there. Coinbase comes in top. Coinbase is really much more of a crypto company. They are the largest exchange in the US, but they have done some activities in the security token space. 6 is the Swiss Stock Exchange. They are doing launching an all-digital security token stock market, doing some great things there. T0, probably the most well-known, it's a subsidiary of Overstock.com. They've been doing a lot of stuff. Then we see Polymath, Seed Invest Security, Securitize, and so on. If you guys are interested in the space, maybe Google some of these names out there. And then that's it from me. I just leave you with my last slide here, talk about my company, Texture Capital. Like I said, I founded it last year. We put the team together and we've been applying for regulatory approval, which we hope to receive quite soon. So we are building a blockchain-powered marketplace for institutions and issuers to more efficiently and directly participate in the private markets. And we aim to provide increased liquidity, transparency, and efficiency for institutional investors, thereby enhancing capital formation. So I think we're moving over to this is my contact info if anyone wants to reach out to me. And I think we're moving over to a Q&A session now.
Okay, great. Thank you so much, Richard. It was a wonderful presentation covering so many topics, and it was very informative, and we appreciate it very much.
Thank you, Ali.
Sanjay, are there questions?
Yeah, no, thank you. As we are going to take questions, please type in your questions with your affiliation. But Richard, let me ask you a few questions. This was extremely informative. And one thing relates to this current COVID crisis. Are there any moves to change some of these regulations, let's say Reg A+ or Reg D or CF. Are you seeing any impact on these of this COVID crisis on these regulations?
Not specific to COVID, but we have seen, as I mentioned, the Reg A Plus and the Reg CF thresholds are being increased. So companies can raise more money that way. I did have one idea though, like what we had, this is just my idea, but what we have is you've got a situation where companies are in a lot of trouble, they need money, the government is coming up with the PPP, the payroll protection, there's other types of small business loans available. One idea is maybe that you could use, or the government could use Reg CF to fund some of these companies if they want funding that way. That could be another way. Just an idea. I don't think anyone else is working on that.
Mm-hmm. Richard, I have a question. What countries are leading the way in this area, security tokens? It looks like most of it is in the European countries and North America.
Yeah, well, I'm much more of an expert on North America. In fact, what I think we have here is that, to be honest, the regulatory position here, they came down pretty hard on the ICOs in 2018. And that really did slow the tempo of business development within the US. It slowed it down fairly significantly. And in fact, there are some, kind of fairly well-known companies decided to move their operations outside of the US. But the US is the largest capital markets in the world, and I think it will have no problem catching up. Europe definitely seems to be pretty open to it. From what I can see, Switzerland in particular with the Swiss Stock Exchange as a lead, I would say they're probably one of the leaders out there. But what you also see is that there's lots of these very small offshore type companies who are trying to make a play for themselves. So, or trying to make a name for themselves. So there's the Seychelles is trying to come up with a security token initiative, Bermuda, some of these companies like this, Gibraltar, Malta, these companies, which are small islands somewhere, somewhere around the world, are trying to be at the vanguard here because it's difficult for these companies with a very, very small GDP to grow and differentiate. So they're kind of jumping on this new technology. We'll see how that goes.
Yeah. Also, another question is, how do we make sure that the tokens that are issued are tradable on a secondary market? It's a very, very problematic issue if we're not careful, right?
Well, if you remember back to one of those slides I showed you, secondary market liquidity was seen as one of the biggest benefits of security tokens. So we do need to have that. That's my belief. My background, as I mentioned before, was in trading. So I was focused on trading for most of my career, and that's how I'm coming at this. Right. I think making these tokens tradable is very important, and that's what we're trying to do at Texture Capital. But you need to do it in a regulated way. So right. That means you need to have an alternative trading system that's regulated under the Exchange Act, or an exchange like the Boston Security Tokens Exchange is doing.
Would you address the available platforms also, and what are some of the major players in this space?
Yeah, I mean, I can jump back to the other slide here. Oops. Sorry about that. This is damn it. Anyway, let me just record it from memory here. It was Coinbase was near the top, 6 the Swiss Stock Exchange. These are the trading platforms.
Right.
I think you're alluding to. In Europe, there's a company called RChat, which is developing a security token exchange. But then there's other players in the ecosystem who are more technology providers. So Securitize, Polymath,
right.
Vitalo, these are providing the technology to help you tokenize. Mm-hmm. I'd say they're some of the leading players, but it changes as well. It changes over time as new players come in, and hopefully, we'll see my company's name up there soon.
So very good.
Thank you, Richard. We've got 6 questions. If we have enough time, let's go through all of those.
Okay.
The first one is from Casey Riddle. The affiliation is not known at the moment. The question is, Are there a lot of crypto asset hedge funds?
Yes, there's a lot. There's fewer than there were. So I think when Bitcoin tumbled from 20,000 to 3,500, a lot of these firms lost money and went out of business. But there's probably a couple hundred globally out there, with maybe 100 or so in the US.
That's impressive. The next question is from Annette George from Morgan State University. And it's somewhat related to my question. With what's happening in the economy currently, do you believe that blockchain cryptocurrencies is going to be widely used in the near future?
So I think what Annette is talking about, or maybe talking about, is the Fed printing all this money here, $4 trillion or whatever it is. Yeah, I think that, I mean, I think that's a scary prospect. What's going on with, asset prices crash, the Fed starts printing money, you get this kind of V-shaped bounce in the stock market, and it makes you wonder where things are going to go from here. We're in the middle of this pandemic. We don't know what's happening. We don't know when we're getting out of it. So two, I think, of the best bets out there are probably Bitcoin and gold in this market. But this is not investment advice. So don't take it that way. But they are kind of freer from government intervention and things like this.
Thank you. The next question is from Aaron Peterson. He's a undergrad student in the supply chain program. His question is, how soon do you see blockchain being implemented into supply chain to implement accountability in the supply chain?
Yeah, so supply chain is an interesting use case. It's similar to the trade finance a little bit. So supply chain and trade finance both have the element of we're tracking how things are moving around the globe. And that's a complex process. There's different countries. When something moves from one country to another, there's a customs check and there's a border check. There's different languages. There's sometimes things are like bills of trade can be paper format or PDF format. So you need to digitize these things in order for them to work on a blockchain. I'm not personally. I think a lot of people have invested money in this and are focusing on this. I think it's a difficult one. So the question, how soon? I think I think there's some proof of concepts and limited use cases, but I think we're a few years away from it really hitting prime time there.
Thank you. The next question is from Felix Ayadi from Texas Southern University. And his question is, what do you think will be the impact on monetary policies in developing countries if they plan to allow security tokens in their domain?
Well, security tokens, I don't think will make any difference to that. They may be able to attract more business if they become friendlier to this, like I mentioned, the Seychelles or Malta or Gibraltar or whatever. What I think could be interesting in some of these countries is stablecoins, which we didn't talk about. Stablecoins are cryptocurrencies that are pegged one for one or have, intended to represent a one-for-one relationship with a fiat currency. Now, there are a lot of advantages to that in terms of transparency. They can travel across borders much more easily. There can be faster settlement and so forth. So I think they could, and we've got quite a few countries looking at that. I know Barbados is looking at issuing a digital currency. They're known as CBDC in that way, central bank-backed digital currencies or stable coins. That would potentially make their currency much more useful as a medium of exchange, as a medium for trade, which could potentially give them more control over monetary policy. Instead of only being a price taker to whatever the dollar is at, they may be able to get some more control here. But it may, then again, it's probably a steep hill to climb to really take on the hegemony of the US dollar.
Thank you. The next question is from Ziping Wang from Morgan State University. And this relates to your trade finance aspects. The question is, how do you see the future of digital securities in international trading business?
So one of the things people say about security tokens or digital securities is that they can trade globally 24/7. That's just not true. That's very much a misnomer. Crypto can, Bitcoin can trade globally 24/7. Just because you're putting securities on a blockchain doesn't mean they're going to inherit those attributes. You know, Ali, we talked about having security trading platforms out there that can support this in a compliant way. You've also got different regulations in different countries. So just moving a security from one jurisdiction to another, security tokens are securities, remember, as I said in the presentation. Moving a security token from one jurisdiction to another is not the same as moving Bitcoin from one jurisdiction to another. So I think it could be, you know, a decade or more before we see any kind of global security token market.
Thank you. Then the next question is from Casey Riddle of Savannah State University. And this question deals with the correlation of cryptos with any other market.
Well, one of the main investment theses for Bitcoin and crypto was that it was uncorrelated to other markets. So, you know, you'd see a lot of interest from family offices and other long-term investors who are looking at crypto and saying, well, this is an asset with low correlation. And if you've studied any kind of finance before and you've looked at how your modern portfolio theory, adding a low correlation asset to your portfolio can improve your risk return payoff. So having low correlation is a benefit. It's also got high potential upside. It has historically had low correlation, although this year, I mean, everything's been weird this year. For some periods this year, I think the correlation has increased quite a bit this year, particularly in February and March. Bitcoin and the stock market were very highly correlated, which has been unusual for most of Bitcoin's history and crypto's history.
Thank you. The next question is from Dr. El Mahdi from Morgan State University. And the question is, what is your opinion about the impact of Bitcoin halving event on cryptocurrency and Bitcoin during the COVID-19 crisis?
So the halving refers to the halving of the block reward that miners receive for verifying transactions. So that's based on a programmatic schedule that was originally built into Satoshi's blockchain on how he would see it developing. So over time, as the network grows and Bitcoin gets bigger, you have less of a reward for the miners in the network. So that mining reward is about to halve, which can essentially mean that the new supply of Bitcoin is about to halve, to be cut in two. And as we know from economics, when supply goes down, price goes up. The question is, how much has this already been priced into the markets? I'd say it's probably been priced in at this point. I don't think we're going to see a big jump on halving day. And as for the COVID-19, I mean, it kind of goes back to my other answer about global monetary policy and money printers going brrr, and maybe people are looking at different asset classes now.
Thank you. The next question is from Dr. Kimaju Brown from Morgan State University. Would you say something about the effect of the COVID-19 shutdown in the world of digital securities, first as a whole, and second within Texture Capital?
Well, I think what we've seen, COVID-19 is, we're all sitting in our homes right now, doing or watching this webinar. We can't go out, and we're not buying food from the shops and restaurants and all the rest of it. So the economy is in for a real tough turn, a recession, hopefully not a depression, but maybe we'll see. And what you've seen in the public stock markets, we had a big drop of 30%. It's bounced now, but certainly the risk reward, the risk has gone up in the markets. Public markets, we don't see what's going on so much, but you look at what's happening in private markets, sorry, you'll see that valuations for startups trying to raise money are being cut by about the same, around 30%. There are companies who are, the companies that probably fare worse now are the late stage ones. So any company that did an IPO last quarter just timed it perfectly. Best wishes to them. But if there are companies that had been delaying their IPO or were planning to do it in Q2, it's been very bad for them. I think we saw Airbnb had to take out a loan recently, a $1 billion loan, or I think a mix of debt and equity to keep them funded, whereas they had been planning to go public. I imagine that IPO has been delayed now. So COVID-19 is affecting capital markets. It's affecting the supply of capital. Investors may have lost money in the stock market, they didn't have as much money to invest, or you may have allocators such as pension funds who have been allocating to the private markets, which is what Texture is focused on. They are now finding themselves relatively over, let's say an investment allocator such as a large pension fund maybe wants to have 5% allocated to private securities or private equity. When the rest of the market goes down, that 5% in effect goes up. So now they find themselves over allocated. So they're maybe going to pull back from the private markets. With companies in a lot of trouble here, many are, demand for capital is going to go up. But and at the same time, the supply of capital is going down as people are becoming more risk averse. So for Texture Capital, we're a startup here. We haven't, we're still waiting for regulatory approval, I think we need to figure out, revise our strategy in light of this environment. But I think there'll be, bearing in mind how these dynamics have shifted. We're a young company, we're a new company, we're very agile and dynamic. I'm hoping we'll be able to figure out a solution to help us grow.
Thank you, Richard, and I hope you get your regulatory approval very soon. And we are almost out of time, so Dr. Emdat can take over. Thank you.
Well, thank you, Dr. Bapna. I want to really thank you, Richard. I appreciate your gracious acceptance of this invitation. This was a wonderful webinar. A lot of information packed into this 1 hour time frame, and some good questions. I want to thank the attendees for joining us, and I want to invite everyone to join us again on Thursday, same time, same place, for Hester Pierce, the Commissioner of SEC, a conversation with Hester Pierce. I want also to thank our fantastic team, Tainisa Walters, Judy Schnittman, and Sanjay Bapna for helping putting this webinar together. Again, thank you. Be well, stay healthy. We'll talk soon, Richard. Thank you. Thank you all. Bye-bye.
Thank you. Bye.